friends, welcome back. I'm Rocky Outcrop. I've just come back in from being outside in the sunshine. Let me take those off and sort out my hair because I just wanted to start off the show with you seeing me sit down and knowing that this thing is all recorded live without any cuts and all the rest of it. And actually, this is how you look at charts and whatever else. So, right, great. Let's get into it then. I've not looked at the Bitcoin chart today. Let's do some technical analysis on this bad boy. See how we're getting on with the price action and all that good stuff. Thank you so much for joining me. Hope you get enough value from this episode to tempt you into hitting that subscribe button, because you know what? Just watching this video helps the channel an awful lot because hardly anybody does. And if you hit the subscribe button, then there's a chance you might come back to watch some more, and it helps people also get exposed to the video with the algorithm and whatever else. So, so it would really, really help the channel. I'd appreciate it. Let's take a look at the charts together then. I've got the CME chart up behind me right now. Oh, actually, what am I going to talk about in today's episode? A couple of things. The price action as ever, and I was also requested in the chit chat on the Discord yesterday to take a look at risk management. Okay, so I thought I would talk about that in today's episode as well. Why not? Let's see if I can fit some of that in here for us. But of course, as ever, I'll start off by taking a look at the charts. And this is the CME chart. So, okay, so just looking here, this is the 24-hour chart, and you can see that we're above the 21 EMA over here. I suspect that there's a difference between this, where exactly this is positioned on the CME chart and where it's positioned on the spot prices. Let's just dive over here and take a look. And indeedy doody, there is. You can see that we're actually come down here and we've touched this a couple of times. Now, was that black magic that enabled me to do that? No, it wasn't. It was just actually that I have the Bybit app on my phone, and that you can use for alerts and stuff like that. You can use anything you like for alerts. TradingView's got alerts as well, all that sort of stuff. But I thought I'd try it there one. And I saw it come up today several times saying, oh, the price is crossing the 21 EMA on my phone as I was out and about. And well, so I kind of knew that it would be. I could see that it wasn't touching it here. But what does that mean for us? What's actually happening? And by the way, if you want to join up to Bybit, you'll find an affiliate link in the description down below. All that sort of jazz helps support the channel. Obviously, as you know, you've watched YouTube before. I've got those affiliate links just like everybody else. In fact, if you want, you could also use KuCoin. They've got an offer at the minute, exclusive for Rocky Outcropticians, I do believe, as that's what I told them that I needed the offers to be, or else I wouldn't ever talk about them. And there's an affiliate link for KuCoin as well there. They've got something on the go with Link. If you trade Link with them, and I think if you do 100 USD worth of trades, then they give you $10, something along those lines. Ask me in the Discord if you want any more information on that thing, and I'll fish out the message that she sent me on the Telegram chat that she started with me, the lady from there. Anyway, so we can see that this is of importance to the prices, because as we've talked about numerous times in the past, just the 21 EMA alone is a pretty good indicator of trend, and we remain above it just now. So we still remain in that bullish stance on the medium sort of term, or short term, or long term, whatever you want to call it, really, to be honest, because it all depends. What do those words really mean to you? Because, of course, in terms of business, if you're familiar with the terms short-term, long-term, and all the rest of it from business, what you're talking about is the medium term being 2 to 5 years. So that's not what we're talking about when it comes to trading. So so short term, long term, all that stuff, and we can see that we're from that perspective, we're still in this bullish scenario. Okay, and that's pretty good news for the old BTCUSD. And if we look here, we also know that the prices came down to the bottom end of our parallel channel, touched them, and now have actually gone up towards the top side. So that's also positive for yon BTCUSD over there in the BTC world. And we can then see then what our next sort of targets could possibly be. Just looking at this potential area for us at 12,000 as being somewhere that we could see the prices going up to. And this price up here at 12,500 is being, the very greedy profit-taking target on that one. And then, of course, the sort of key areas for us to be remaining above in terms of the daily time frame have got to be coming in there 11,590s, or let's call it 11,600, right? And sort of daily closes below there that open up and subsequently have another day opening and closing below that price, I think would kind of spell a little bit of sort of downside price action for us. If we look back in the past, we can see that we had stuff like that happen, where we saw 10% in the price action just purely when in and around those times when we cross over the yellow 21 EMA there. Let's just get out the old measuring tool and do a couple of examples. Like over here, we saw that the prices dropped down 7% there, just from the point of the 21 EMA down to where they ultimately turned around at. And there'll be numerous other examples in the past. Here's an example over here. So there was a red candle there. and it went down 5%. So yeah, anyway, you can see that obviously that would open up a good opportunity for shorting it as well towards the downside. But there's a couple other little differences that we could also bear in mind being up here in this price action, given that the prices that when they came up towards this area actually kind of came up here so fast that there wasn't very much sort of liquidity on the order books, and that movements down below this area could spell bigger fall down and drop downs in the price. So we've kind of spoke about that in detail as well on Friday's episode, and I've spoken about it in enough detail overall recently in recent times to kind of cover all of that for us. So we know what the chat is when it comes to the potential for things like this bearish divergence to play out. If you're looking at this and thinking, why is this bearishly divergent? What's going on here? Well, just looking at this price action, we can see that from this high over here on the RSI and all the ones down below, and then up towards the most recent high, that we've got lower the numbers on the oscillators down below, showing that then that we have this downward slope as I've got drawn in here with this red line. So that's bearish divergence. If I could speak, that's bearish divergence. Looking between these last two highs though, just like if we consider this one here on the 11th of August and the most recent high that we had on the 18th of August, and we bring up the RSI full screen so you can really see it is actually bearishly divergent here on the RSI, which is hard to see in this sort of format here. If we look at it on the stochastics, you can see that it's not actually bearishly divergent on the stochastics. On the DMI, let me just bring this up a bit bigger if I can. I'm always clicking in the wrong place on this one. Got some sort of brain problem with that one. You can see that it came up higher. So again, it's not actually bearishly divergent between these two highs on the DMI down below. And well, the MACD, well, it's kind of looking a bit of the old, it's got a bit of the old bearish divergence on there as well, does it not? Given that somewhere in this area and somewhere in this area that we're looking at between those two highs, positive down to the negatives and all that. So there's bearish divergence here as we come up towards the top end. And of course, that does mean that we could obviously see something playing out from this. And what have we had so far really on that front? Well, nothing really to be written home about. Overall, because the price has managed to stay above this 11,550 area over the last few days, we didn't actually put in a lower low. The prices would have had to have closed down there about 3,400, 3,350, let's call it actually, to get a lower low in. And because we're in this upward trend, you could look at this and say that that's hidden bullish divergence. Now, I actually, when it comes to me and looking at divergences and stuff, I tend to kind of pin it onto the trend and say that if we're going sideways, there's no point in looking for it. Now, that's not necessarily the case. Of course, you can look for these things just in terms of whether or not it was better, higher or lower than the previous low and whatever you're looking for. But it's harder to kind of define when you'd have hidden bearish divergence and certain things like that. If that's what if you're not talking about it in the context of a trend overall, anyway, but. You can do it at any time, really. So don't let me put you off from doing that yourself. But I do tend to talk about it from that perspective of given the trend, especially given that it helps integrate better with your technical analysis at home to help you, not step on any toes. You could just say, well, I'm looking at this, and then Rocky says this from the context of this particular trend on that particular time frame, etc., and run with it. So yes, so we have that. So we have both bearish divergence and hidden bullish divergence potentially on the go, depending on exactly how you're going to cut the cheddar here on this one. Just again, a reminder then, this height here is lower than the subsequent height, and it's from this time over here in the 10th of August. What we do have though is these other highs along the way, and you can see here just this high was higher than the subsequent high, which is of course then between these 2 points here, kind of bearishly divergent, you could say. So you can cut this down into numerous different little slices. Use your potato peeler on it if you want to get those even thinner. And of course, you can then look down across different time frames and consider different aspects about that and whether or not it's divergent, etc., etc. And just looking then here on this, we could say that we're in a sort of downward trend currently on this side of things. Here's a low and here's another low subsequently. That's the low. That's the subsequent low coming in. Here in the stochastics, you can see that that's actually then bullishly divergent because this didn't actually make it as low. And on the DMI, what have we got here in the DMI? That seems to be fine. And on the MACD, then you can say that that's bullishly divergent on that one as well. So then it's kind of sort of two different stories going against each other here. And of course, that kind of does makes you wonder. Okay, there's a warning sign there for you. And in terms of this downward trend. So again, the two targets that we have in mind, of course, have to boil down to that 12,000 area towards the top side and the 11,600 area towards the lower side, with the current prices being in there at 11,783, and that's really what we're trading between at the minute. Movements beyond those two zones really could see the prices going up higher, and we can check it out and say, well, look, would we have any bearish divergence or not on the go, etc., etc. Now, if the prices did drop down from where they are just now, however, bearing in mind that we've called this already, this chunk here, a downward trend, and we're looking at this high here and saying that it is indeed lower than the previous high as part of this downward trend, and looking down towards the oscillators down below, you could very much see how this has come up much higher than it had in the previous high. We've seen the MACD was just getting back to that neutral area, and now we're up here having pushed on up the way. For example, on the stochastics, you can quite clearly see that we're gone up into this overbought territory as well right here, despite the fact that the prices haven't managed to put in a high compared to the previous high over there on the 20th of August. Okay, so you could say on the 4-hour time frame that you're looking at the sort of the inverted story from that daily time frame in terms of how things are going, and maybe then put on your skeptical glasses when it comes to this 12,000 target just in the meantime, and say that maybe perhaps we have some other targets towards the downside to go. And indeed that kind of ties back together then to looking towards these things like the moving averages, and saying that if we were to come down below this on the 4-hour time frame, then the prices would be going down below that 11,667 area. If we do that same dance on the daily time frame, then you are looking at the prices again in around about where this 21 EMA is, and it would come down to the question being, well, are we actually closing it below 11,600 or 11,550 on the daily time frame? And looking at this and saying, well, that could maybe be us coming down here, challenging this bottom end of the channel again, and perhaps pushing on beyond it if that happens to be the case with the price action. Okay, so what we've talked about so far, just to sort of wrap things up there on this front, is that the spot prices here on this are I've got the 21 EMA kind of closer to where the current prices are. We have this upward slope here in the 21 EMA, and looking at the 55 there, it's they've not crossed as well, but they're looking like they could come in and cross. Over here in the CME charts, you see a different story where the 21 EMA has come in here with a downward slope, and it has indeed currently crossed over the 55 EMA, or has it not? No, they've kissed, but it's kissed the girl and perhaps running away with a slight upward slope on it. The opens and closes of this next wee period in terms of the smaller time frames will dictate, of course, what happens on the bigger time frames, as you'd expect. It is time that we're talking about here after all. So yes, that was how that goes, but the 21 EMA happens to reside a little bit further away. Coming in here and touching this 21 EMA would see the spot prices perhaps go down and visit those targets that are lower down below, in terms of putting in a lower low over here on the daily price time frame compared to that at 11,000. Pardon me, I'm sorry, I burped. 11,420 or so. And if that were the case, then of course you'd be looking at having put in a lower low, really, for in terms of the first time really since back over here. Is that lower, for quite some time? Can we just skip it so I can continue on with the show? Thanks. So that's what we'd be looking at. So you want to keep an eye out for that. And if we did then move on down the way, then you've got these other targets towards the downside. And I think the clearest sort of big old sort of scare your pants off in a sense, or else make you salivate if you're a bear, has got to be where the CME gap is here on the daily time frame. On the, in fact, is well visible on the weekly time frame here, right in there at 9,800 on the CMEs, talking sub 10k prices again. And of course, the psychology and the overall crypto market would be quite affected by that. But AFFECTED, affected by that. And what could the effect of that EFFECT be if they were to be so AFFECTED affected? Then perhaps we're coming down and looking at going into this key area of consolidation again. We'd want to see the prices stay above overall that 9,500 area, or else perhaps we've got a sort of the trend turning around. Now, whether that means that the macro trend trend of the sort of bull market since March has turned around or not. That's another question. Currently, you've got two sort of perspectives on that. People could be looking at this as a weekly time frame, kind of make this a bit easier on ourselves by looking at the monthly time frame and saying, you know, what people are kind of considering at the minute was that subsequent to the move up above the 10K area, you know, we initiated what could be considered to be a bull market. And then other people looked at it and said, well, hey, it's above these other targets, like you know, a lot of people were buying the top there at 12K, for instance, when the prices came up past this 11,500, up to 12K, 12,500 that we saw there the other day on the 17th of August, and then the prices have dropped down subsequently. So people would maybe thinking that once we got up towards that 12,500 area, breaking past where we saw the highs back in June 2019, in terms of this weekly time frame, that perhaps, you know, we're in an upward trend. As we see here, actually, just as I'm speaking, that Bybit notification just came up, said the prices are changing, are crossing over on the 21 EMA. Let me just see then right now if that is indeed the case over here on the 24-hour time frame. And it's not in terms of this chart. Can I get Bybit up? Let me just see. BTCUSD. Is Bybit there? There's Bybit. And then what is just see? Maybe I've got it on the wrong settings or something, but it did just get the notification there. What does it mean? Why is it telling me that? Because it doesn't look like that at the minute. The 12-hour, 4-hour. Was it 12-hour that could potentially, could it have been the 12-hour I've got that notification on? Well, no, we've not worked down there yet. 1 hour? 15 minutes? 30 minutes? 30 minutes? Was it something like that? Maybe I've set it up wrong. I wouldn't do this. You know, I'm not interested in a crossover in the 21 EMA and the 30-minute time frame when I'm out enjoying the sunshine at the beach. But, you know, maybe that's what it's talking about for me. I'll have to open up the app at some point, I guess. Anyway, I don't particularly care. That's interesting for us. You can, anyway, just in terms of, like, you know, the short-term timeframes in this chat that I've been having and asking the question about, you know, what could we be looking at just right now in terms of the price action and, of course, those targets and everything else that we've had on the go recently. Why am I even looking at the 30-minute time frame? I mean, this doesn't benefit any of the viewers. By the way, if you do get value from these episodes, like I would say, please hit that like and subscribe button. We'd really appreciate it. 4-hour time frame over here in Bybit. You can see that we've had the 50 simple here operating in terms of the resistance in the last couple of periods here that have been printed onto the chart, and we've got the 55 below us, an upward slope on the 21 EMA. Looking here with will we maybe, you know, get a cross here, which would be positive since this negative cross that we've had over here, and that's a heck of a lot easier when the price action is living above the 55 EMA after all, anyway, which we're doing right now. So you can look again at these numbers. 11,730 would be where that 55 is. The EMA, this 21 EMA on the 4-hour time frame, 11,700, and, you know, closes below that could then trigger these sort of that cascade up the time frames in terms of how the stance of this thing goes over the next few days. It could do, of course, movements towards the 12,000 area and stuff like that would be initiated perhaps with decent closes above 11,800 or so. I mean, that's where you could say their last little high area was on this one, and that if we did that, then this would no longer be bearishly divergent that we have across the board, or a hidden bearish divergence we have across the board here on this. Continuation divergence, by the way, is what hidden bearish divergence is on this asset right now, on this one, and maybe you get some follow through from, where is it, from this sort of stochastics and MACD bullish divergence that we have just there. Bear in mind though, that's only on half of them, and this is, you know, this is just the risk on this. So I think then, okay, that can kind of cover up everything that we have on that front. How long is this video so far? Just so I know I've not rattled on for too long. Recording 18 minutes. You kidding me? This is an 18-minute video so far already. Wow. Gone on for too long. Risk management, right? Okay, I'm just going to publish it anyway. Risk management. So I wanted to talk about risk management just a little bit. I suppose I'll have to be briefer than I otherwise would have been, I guess. You probably looked around and thought about risk management as yourself quite a bit and looked to the internet for some advice on that. And what you'll be finding when you read these things, or you listen to the podcasts or watch the videos on YouTube or whatever else, is this generic sort of advice about things. And it kind of, a lot of people talk about the 1%, 2% of your account risk sort of strategy, and that actually is quite a good one to use yourself. And how does that really work? Well, hey, if you're looking at something like Link or whatever, it's easier to talk about because then you can calculate this quite easily, especially with spot price trading without leverage. Then you'd be looking at things like, say, if this was what's the price of this? $15 at the minute. Okay, it'd be nicer if it was $10. When it was $10, the math would be easier. $15, right? So say you wanted to risk, say you had 10 grand and you wanted, we'll call it USD, and you did the 2% thing, then 2% of 10 grand is $200. So that'd be your maximum loss that you'd be wanting to have on that 10 grand. One thing you'll notice whenever you watch these guides is then that they don't, recalculate after the first thing. They say, that would be as much as you want to lose on any given trade. And then you would only be able to lose 50 trades in a row before you'd lose your entire account. Sure, it would. Of course it would. But what if you did that strategy whereby you only did 2% of your account, and then if you lost your first trade, you've got 2% of 9,900, which is $180, right? Is it? You do the maths, and then you're looking at that as being your maximum loss, okay, or whatever. You could do it like that. That's probably a bit more sensible, especially when you're starting, because the likelihood is, let's face it, that you're probably just looking as well to see when you can increase the amount that you're able to spend. And if you're looking at it from that 2% sort of target area, then you can only really increase the dollar amount of your trade. So say you're willing to you're risking whatever, say it's $100. And you want to be able to risk $101, then your account size would have to have gone up by $50 in order for you to be able to increase that. So that's what you're looking at. If you want to think about it in these sort of incremental ways, something that is not on any video. Just thought I'd throw that out there because that is going to, appeal to your own sense of psychology about this, because what you're really looking at when people say these things about, you could lose 50 trades in a row, it's like, yeah, but then I've lost 98% of my account value. If I win on the 49th trade, the statistics are that, that's very, very unlikely to happen. Yeah, but you've lost 98% of your account by that stage, okay? So just remember that, say if you've lost 50% of your account, that whenever you're doing a 2% trade risk strategy, and you've already lost 50% of your account, that's actually a 4% risk strategy, okay? Just bear these things in mind. I thought somebody said want you to hear you talk about risk management a wee bit. Well, I could go on and on and on about risk management, but I think that's the one thing that's quite obvious, is it not, and missing from all of them. Go in, watch them now after this one, and you'll see. Actually, watch the other videos that I published today first, right? Nice. Rocky Outcrop. YouTube.com/Rocky Outcrop. Share it with your friends, by the way, because your friends are missing out on this great stuff on a daily basis. Monday to Friday, here I am making fan-dabby-dozy episodes. So, hit that button. And hit the bell button too, actually, because I'm shadow banned on YouTube. Yay! And with that lovely shadow ban, you can see that we, and why am I looking at Link right now? Well, I guess if I'm looking at Link right now, I could mention that, no, I've got a Link episode. Go check out the Link episode. So that's the first thing about risk management I wanted to get out there, because that's something that's missing and it's fairly obvious. And whenever you're watching these videos, I was thinking to myself, because the person had asked about risk management, what am I going to talk about? And I just stuck it into YouTube to see what came up, and I saw one by the Evercrap crypto burb. I'm not a fan of any of these paid group things and all the rest of it, where they get in a bunch of experts, right? So they had a podcast on there, and they had their god Crypto Bird, and they had various other people chatting. You can find this, I think, if you search Crypto Burb risk whatever, who cares? And they get some psychologist in there, someone who's a PhD, apparently psychologist with years of experience from working in a clinical setting in a hospital, and they're there to share from a mainly cognitive psychology basis, and they use words like that, and all it all adds up to is crap, by the way. Right now, somebody who's worked in a hospital for 10 years is not really going to be able to help you with your psychology any better than perhaps your mum when it comes to talking about things, or anybody else necessarily. That doesn't qualify you. Being really good at using algorithms doesn't qualify you to talk about
risk management and everything. They don't qualify you to talk about it. So I would just thought that's the sort of the second thing about risk management I want to chuck out there, is that everybody out there giving you expert, in inverted commas, opinions about risk management and anything to do with trading is talking out of their blowholes most of the time, because really what they do is they're qualifications led first people, and that doesn't make a difference, and neither does experience working in a hospital, unless it was a hospital for those who are recovering from, say, having attempted suicide after losing their trading account exclusively or something like that, or whatever. And they were like talking to them about it, and it's like, well, yeah, after years of talking with traders and there's a few people out there who are good for looking at this sort of thing. In which case, I would recommend reading the book, The Disciplined Trader, and then following that up with, or just skipping it and going straight to the better book of The Trading in the Zone by Mark Douglas. Is that right? Mark Douglas, is he the guy that wrote Hitchhiker's Guide to the Galaxy? If I just mix those two up, search for the name. I can't remember, whatever. Forgive me. Like, yeah, if I edited these videos and was all, and you could see me going cut, whatever as a mid sentence, then you would know that I could have just looked that up on Google and got the right name for you. Sure, that might be his name. I can't remember right now. Douglas Adams wrote it. Okay, so there you go. Resolution. Right. And on what else am I looking at? Oh, yeah. Risk management. So there's two aspects to risk management, right? One is that particular thing that you'll see everybody talking about, which is to do with, how much you're willing to lose at any particular time. There's two ways of kind of thinking about that as well, with it as a sort of substructure. If you're going to talk about losing 2% of your account, you can obviously structure it from how much would I have lost by the time that my stop is triggered, where you're looking at a sort of risk per share basis. And that's why I was going down a link there. So say you were buying something that was $10 and you had $10,000 and you wanted to, and you were limiting yourself to $200, because that's 2% of your account, and you then and then you were and it cost $10. Then if you wanted to stop out if it dropped down to $9, your risk per share is going to be $1. And if you let it drop down to $9.50, your risk per share is 50 cents, right? And if you let it drop down to $8, then your risk per share would be $2. And then with that number, you can work out then how many shares you're able to trade with. So if your risk per share was going to be $2 because you're willing to let it drop from $10 down to $8 before you stopped out, then you're looking at saying, right, well, I've got an account size of $10,000. I'm willing to risk 2%, so that's $200. So my risk per share is $2. So that means that I can buy 100 of these things with using my entire account here to buy this thing, say without any leverage or whatever. Say that was what you did with Link at $10. Then you were saying, well, hey, it's come up to $10. I can afford to let it drop down to $8 if I stop out at that point there. And obviously these maths don't really work out because you're probably going to use a market order to stop out. Which might have an additional fee on it. You may say you're trading on Binance and it costs you the same no matter whether you're doing limit orders or market orders. Then you're not thinking about that. I think that's a 0.1% each way, is it? So you're looking at 0.2% anyway. So your risk there is going to be 0.2% of the entire order size. The order, right? So that's $200. So you're losing. The answer to this quicker than I do. Why I'm even bothered to work it out. So 0.2% of $200. On that one, and then and in addition to whatever else you'd be losing, right? Fine. So that there's obviously this isn't the exact numbers, and but yeah, and so then you'd have what? So you'd have 200. What did I say? So you'd have 100 Link. You'd have $10,000 in your account. You'd buy Link with that. You'd get 100 of them. Then you'd put a stop loss in as soon as you'd ordered that at $8. That means that you've thought to yourself, right? If it drops down by this, then I'll have 100 shares at $8 each, which adds up to $8,000. That's $800. Okay, forgive my maths, right? I'm just trying to give you examples here, and we'll run with it anyway. And then whatever, right? Cool. So you get that aspect. So that's that aspect of things, of the 2% thing, right? Now you can go and listen to everybody who's scripted out their chat about it to get the sort of the exact number, maths, formula stuff in your leisure time, but you get it. You get the point, right? That's like basically it. And then there's also the idea then of well, how does that really work, right? That's kind of fairly arbitrary, isn't it? Instead, what if you were looking at things like the Bitcoin pricing right now? First off, it's harder to work this out because we're looking at you on face value you might think that it's $11,750 per share at the minute, but of course each contract that you get when you're trading these things on these sort of exchanges like Bybit and whatever else are done by each one's worth $1, and then it's determined by the so it's not quite so easy to work it out for the maths wise, but actually is just as easy really overall, because it's the same sum. So it is just as easy. You're looking at how many contracts you've got, yada yada, and how much they're worth, and then how much they'd lose, and you can work that out in your own time, okay? But that adds up to sort of fairly arbitrary type points where you're saying, well, where am I going to put my stop loss on this sort of a thing here? And you very well could, be thinking about this slightly differently. You could be thinking like that you say you were shorting it off the back of the 50 simple moving average. Maybe you're looking at it and saying, well, look here, just in recent times, we've only ever moved, since the 18th of August, and I'm on the 4-hour time frame, and I'm looking at this, and this is just an arbitrary example again. But here's like, look, that looks like the max that we moved. We moved past that by 0.35, and that was $41. Went $50 above it. So you could be saying to yourself, well, hey, I'm going to stop out $100 above the 50 moving average if that's the case. And then of course you're looking at having to work out what your risk would be off the back of that if you want to stick to this 2% style gizmo. And then maybe you're looking at this and saying, well, actually, I'm going to take profit down here. And then you're not really looking at one of these risk to reward things like you have, because like, where is the tool? So this is a sort of thing that nobody really has in their videos about stuff, like whatever. They don't really talk about how this all goes together. But this is how it all goes together here. So your stop, what was it we said? The stop would be $100. We said $100 up above. Is that what we said? I think we said $100. Let's stick it down there at 99.99. That's close, or 99, whatever, right? Cool. So there's that. And then your reward, if you were actually just getting out here at the 21 EMA, for instance, would only be a risk reward ratio of 1.26, which is pretty shoddy when you're looking at these examples of things. Of course, then if you wanted to have that higher risk to reward ratio, when people like to look for things like, say, 5-to-1, for instance, or 4-to-1, so here's 4, then you're looking at your stop being there just $30 above it. So maybe instead, you'd have to kind of reconfigure your thing. So there's a strategy element to this. And when I talk then about frequently on the channel about how you can manage your risk easily at a certain point, how this makes it easy for you to manage your risk, is because just knowing at what area you're going to consider yourself to be wrong at enables you to choose then where you'd be getting in and out of a trade in order to like make it so it was worthwhile for you. If you thought that so you can do this in whatever way you want to do it, right? So, and this is not a video teaching you how to trade, but say you wanted it to be $100 above the 50 simple moving average. Let's just do this, $100 above the 50 simple moving average. There's 102, that's close enough. So then you wanted your risk to reward to be, if you thought that the price would come back down to test the 21 EMA, you want it to be about 4-to-1-ish. Then you're looking at this and dragging it up the way and saying, well, hey, I'd only be able to get into a trade on this one if it were to go up to 11,879, or coming up past this point. Then I think I'd be risking just this amount, which is it would be a $43 increase in the price. Going down with a risk reward ratio of 4, you've got that risk reward ratio maybe you wanted to have in the first place to enable you to go into this trade, for instance, and that makes it a heck of a lot easier to be able to manage your risk, compared to various other ways where you still be looking at the risk to reward ratio for you. And of course, you may not get that trade then if that's what you're doing and whatever else. But there's it depends on what you're looking at, right? But then if we do see things other things happening, like closes below the 21 EMA, then you're looking to say, right, okay, so if it goes down below the 21 EMA, I'll short it from the 21 EMA again, because the likelihood is it'll retest it having gone below it, and then I'll try and take profit at, say, the bottom of this channel, etc., right? And that's risk management for you. That's kind of what I mean when I talk about risk management. Most of the time, I don't mean you necessarily have to get these things out and do it or whatever. If you've got a winning edge strategy on your trading and you're consistently profitable, then all of this starts to come fairly naturally to you anyway. And stop losses aren't necessarily even the thing if you're looking at the position and you're trading on a small time frame. Say, for instance, you were trading on the 15-minute time frame. You probably, you could do the stop loss at the very start if you wanted to, or indeed you could look at it and think to yourself, right, I'm going to manage my stop loss myself because I'm going to be sat at the computer for the next couple of hours. You could stick a stop loss on every time you went to the bathroom if that's the type of nut job trader that you want to be. I don't. That's not how I trade, but I understand it, right? I understand it. No judgment here. So what maybe you'd be looking at was saying, hey, I'm gonna trade this if it goes back up to the 21 EMA, if it drops down below the 21 EMA, as you can see over here, 1:15, that happened. So then you'd be saying to yourself, right, well, I think it'll come back up and retest it again, but I'm looking back in the past and I'm seeing times when it's dropped down, it's come back up above it by a wee bitty, quite a bit. So we dropped down it here, we came back up above it. It was distinctly, the prices were above it there and stuff like that. Say we dropped down here, came back up above it, they were distinctly above it there and whatever. So you're thinking to yourself, right, okay, well, I'm only going to get into this trade just a little bit above the 21 EMA. I'm going to stop out of it where I think that, we're going past our previous body over here. If we start trading above, say, this area, say this is your strategy for instance, then what you'd say is, right, so I'm seeing the prices go down below the 21 EMA. I believe that they're going to come back up in the next 15 minutes or so, perhaps, possibly. I'm going to wait and see for this one. I'll get in a trade where the prices are above the 21 EMA. I'll stop out of it here at the previous body. And in your head, you kind of work this out yourself, probably more or less. But let's just do it with this gizmo again here anyhow. How does this tool work again? So I just stick it on. Oh, yeah, like that. And then so we matched up. This is where our stop loss is going to be. That's where we're saying we want to get in or around about there, and say we wanted to take profit down at the 55 EMA over here. I should have done this before drawing it in, and it would have looked more like, this is what I was going to say, believe me. Say you want to take profit over here at the 55 EMA or the 50 simple EMA, which are pretty much on top of each other by the point that this got resolved anyway. So either one of these that you were looking at would have been what you would have ended up saying, and then you're ended up with that 4 to 1 profit ratio here on this trade here, yada yada yada. I hope that helps. I hope that helps a lot. I hope you take some value from the episode. And like I say, hit that subscribe button to sort of help, encourage other people to do it. Now, you could then repeat this as well, by the way. You could be saying that if we were to close below this, if we tick down below this 55 or the 21 or whatever, then maybe, I'll do this. I'll go in at this point here. Maybe then you're thinking to yourself like that you've just done the same thing, having got in there. And maybe you're looking at this is sort of like as your next trade and thinking, well, hey, maybe we'll come down here, test these previous lows over here, maybe this is an area where we could expect to bounce at if we did drop down below. That's 11,700. We looked at Rocky's EMA earlier, or TA earlier on. He was talking about these sorts of things. Maybe we could try for one of these, etc., etc., etc. There's your risk reward there. Talking about a couple of shorts, just because that's the way the market's been going for today. If that's what you'd been wanting to do, that would have made sense. Over here, you could have done the same thing in terms of longing it up the way, etc. Obviously, not looking towards moving averages or whatever, but just towards certain targets that you could have had in mind easily enough. I think when the prices were down there at about that 11,600 area, you could have maybe been thinking along the lines of 11,800, for instance, for a move towards the top side, yada, yada, yada. Episode surely way too long, 37 minutes, way too long. Please, though, do share the episode with your friend if you find a lot of value in this. I think there's got to be quite a bit of takeaway value for people in terms of, trading, how to trade, even. I certainly know that if I'd watched this video whenever I started trading, not only would I have got all the takeaway that I really needed to get in order to be able to kind of, think wisely about the market and where we're going at the minute and where we've come from in the first 15 to 20 minutes of the show, and in the second 15 to 20 minutes of the show, I would have taken away a lot of value about actually how to trade, given if I was looking at this from just this sort of time frame here and understood the concepts, felt a bit more relaxed about the fact that these experts, so-called experts, come on and talk about things like neuro-linguistic programming as part of how to be a better trader. Or cognitive behavioral psychology is how to be a better trader. Cognitive behavioral psychology, by the way, my first encounter with it was probably after I'd had some bad stuff happen to me, and it was totally unfair what happened to me, and I felt badly about it. And the person says to me, "So how did you feel about it when these things happen?" And write it down, when this, and then you can look through how and you can do that yourself if you want to in trading. But be aware that all the bad things that happen to you aren't something that have been brought on by somebody else, and that you're dealing with yourself here, and that really, the psychology of your own inner psychology is better managed just by having sort of clear targets at the outset, knowing what you're doing, being sort of proficient in your trading, having a bit of skill, a bit of knowledge, a bit of reasoning behind things, creating an edge in the market, all that sort of stuff, and to think less about how you ought to feel in a situation so that you react differently to it, and instead and being so soft about things and harden up and talk about instead what you're going to do so you stop making the same stupid mistakes over and over and over, and get on with the show. Good job, nice one. Moving on to Ethereum, and I'm going to enjoy doing some technical analysis on Ethereum, Chainlink, and Tezos today. Yes, thanks so much for tuning in. Really do appreciate it. YouTube.com/Rocky Outcrop. Share it with your friends. Oh, by the way, actually, since we're still here and you've stayed past the point of saying bye, and we were talking about this trade and blah da 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 at the same sort of a time, you could also now at this point just simply say, right, I'm going to now move my stop loss down to the point. I shouldn't have moved that at the start. Could have done it like that instead. Right, I moved my stop loss down to there, and that means that actually from that trade, I'm no longer losing anything on it or whatever, and blah 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 blah. So you've got a zero risk trade that's got a 3.7 to 8 risk to reward ratio on a trade that's actually got a zero negative outcome for you. You're sitting pretty there on that one, and concepts like 2% and all the rest of it are just ways of thinking about what your sort of the size of your order really ought to be at a maximum, and best thinking like, when I add $50 on there, I'll add $1 onto the size of my order. That's cool. Okay, and that's how you can manage stuff. Chin chin, cheerio, catch you next time. Best YouTube channel for crypto technical analysis. Yes, check. Lowest net subscribers ratio to how good it is. Check. Share it with your friends because they should. Check. All that good stuff. Yeah, cool. Catch you next time.